The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, when the dust settled on Wednesday's trade midweek, things looked relatively quiet in the grains and oilseeds. Just seemed like we lacked a fresh story to keep the market elevated, and we kind of just leaked lower throughout the day in the grain and oilseed trade. And also, cattle fell apart mid-session, and more triple-digit losses seen there. We're going to talk about things as we dive into the markets and have a conversation with our good friend Mike Zuzolo with Global Commodity Analytics joining us here on Market Talk once again this week. Mike, good to catch up with you. Hope you had a great Thanksgiving, of course. And, looking at this market trade, Mike, it's just another day of quietness in grains, kind of just let the market drift a little bit lower throughout the day.
Yeah, we had some friction that came into the market here midweek, even though we saw some more purchases by China of soft red wheat and even some soybean purchases as well. But the general trend continues, Jesse, heading into Friday's WASDE report of the funds, I think, coming in and unwinding their long protein, short grain mindset that they built up this past year for the most part. And I think that makes sense from a standpoint that the cattle and the soybeans have both had a common mindset to them that they were very tight in supply and their demand was not being rationed as prices went up. And that hit the market pretty hard in 2023. And now in the last 3 or 4 weeks, if we didn't have weather to support us when it came to the South American soybean crop, we've seen a general trend where the hogs, the soybeans, pork and bean trade, along with the cattle, have continued to see leakage. And we're bouncing. The fats and the feeders are back on major support, but we really are just spinning our wheels here at this point as we, I think, unwind some fund-related spec trading. And I know cash markets are not developed as well as we'd like in the cattle, but I think in general, the market is just kind of going through its end-of-the-year mindset at this stage with the support coming in the wheat and the negativity still kind of present with China. And I think that's the things that we have to keep contending with.
Let's pick this apart a little bit more. And you brought up China there, and all great points. I'm on the track with you. I think it's a lot of end of the year type of trading already coming into these markets. We've seen China, though, the one bright spot the last couple of days, they've been buying more SRW wheat. So let's talk about that a little bit, but also pull up our first chart on the video feed. We've seen WTI crude fall back here, another 2-3% on Wednesday. You're looking at a relationship between WTI and SRW here. So talk to me about what you're seeing right now.
Yeah, this goes back to the Bloomberg Commodity Index, the S&P GSCI Commodity Index, all the major commodity indices that, you have a lot of energy weight to those indices. And so you can tell, I think, and infer by this chart where the crude oil is making new 5-month lows, led by the RBOB unleaded gas making new 2023 lows today, and copper making new 2-month lows this week. I think you can infer by this chart that with the soft red wheat is finding support from the Chinese business. It's not finding it from an overall commodity friendliness or a desire by the funds to buy into this market. And this does, I think, go back to the Chinese, specifically what's happening with their hog herd, the fact that Smithfield is now being shut down in Utah for essentially with another, 26 production facilities being announced to go down and be idled. And then obviously the debt rating cautionary tale from Moody's earlier this week, yesterday, in fact, where they kept the debt rating the same, but they said a negative outlook. And so I think that's what's splitting this market up.
Well, and I want to look as well at the global wheat futures. I know we talk about that quite a bit and how that's playing into things here in this wheat market overall. And another chart you provided for us. What are we seeing on the global front? Because I don't, China's in here buying U.S. SRW wheat, and heard some talk. They've canceled some French wheat orders, or at least put them on hold, things like that. So, what's going on the global front here, Mike?
Yeah, I think quality is the name of the game right now with the United States soft red wheat. I have heard that they're in the Pacific Northwest looking maybe at white wheat as well, high quality. I think the other thing goes back to what we and I have talked about pretty frequently here recently, Jesse, and this is the idea of a thaw between the United States and China when it comes to their trade relationship, agriculture at the forefront of that, thankfully, since the San Francisco meeting of the two presidents. But I very rarely make a plug for setting up a trial or becoming a subscriber or client, but these are the kind of charts that you get to look at all the time when you work with me. And this is kind of the global picture, streamlined out, and you can bleed through all the noise and just look at where the prices are in this market. And one of the comments I made earlier this week to Reuters, I believe it was that we are seeing this Russian price and this Ukrainian price really come up since late September, early October, to the tune of about $20 to $40 a ton. That, I think, has meaning to it, and and I think that's part of the equation too. Is that we are, I think, tightening up some supplies in the Black Sea, and while China buys Russian grain out of the Black Sea, the wheat purchases typically go through the train and the rail, but I think they work off of each other, generally speaking, because of arbitrage. That's what this chart is about, is the arbitrage. And when you look at the orange line, that's the USSRW, you see we're back up close to $275 a ton. We're inching up towards Australia's prices, and we're well above now the green line, which is Argentine wheat, and we're also well above the French wheat price, which is the red line. And so I think this is one of the supply demand fundamentals that would kind of give you an idea that today's price action probably was going to create some headwinds if the wheat and the corn didn't play ball, and especially if the Black Sea prices and if the European French prices didn't really play ball with you too.
We talk a lot about wheat being the upside leader, and I feel like the recent rally in SRW wheat has been supportive to the U.S. corn market to some degree. So let's segue into corn and talk about that a little bit. I'll pull up a world corn chart you're sharing with us here today. Walk us through what you're seeing here and talk about your thoughts, if you believe as well that wheat's kind of been supportive to corn here.
Yeah, I think it has, but I think the delivery process was also very supportive. And so in that respect, both of these things were something I was hoping for, well, a couple weeks ago, 3 weeks ago, when we talked at the NAFB, and that's transpired, thankfully. Now, I think we need to start watching the corn a lot more closely. I say that because the rally in the corn has really not manifested itself into a higher price at the Gulf of Mexico, and that's your bold red line. You're talking about around $201 a ton. Notice the big jump in the Ukrainian corn price from about 115 all the way up to $153 here just in the last quarter here during the fourth quarter. So what this chart suggests to me is if we don't get a negative USDA WASDE report on Friday, I think that the corn exports could go up again on the Friday report and maybe take us close to a 2 billion, if not below a 2 billion bushel carryover. And if we don't have a negative reaction from the WASDE report on Friday, and we've got the wheat that's rallied about 90 cents a bushel off its lows, but the corn has not really rallied at all, and you see that the funds are at a 3-year peak in terms of net short position, I think this is where the corn, the next time we go higher in the wheat or the corn, I think the corn may have some real legs to it.
And with corn, you mentioned that net short position. I wonder if we could see a little bit of short covering rally here in the first couple of weeks of December. So, you and I were talking about this before we went on the air. I feel like a lot of funds are kind of positioning themselves, are going to do their best anyway to position themselves in these grain markets ahead of the Christmas and New Year's holiday, Mike.
Yeah, I think so too. And I think this goes back to what the commitment of traders, when you and I talked in the very first few minutes about the funds positioning at the end of the year, I don't want to oversimplify it, but they have been so long, the cattle, they have been so long, the beans, and they've been so short, the wheat and the corn. So that rebalancing, I think, would make sense as we get into 2024. Why? Because maybe China does want to buy some U.S. corn. Maybe they want to buy some French corn and along with the wheat. And if they do, then that starts to give the idea between the wheat and the corn purchases, if that would happen, of a demand low. And I think that's what I'm really looking for here as we go into 2024. And if we have a demand low in the grains, why would you want to be net short? And I think that's really how I look at it. But we have a big roadblock right now, potentially, and that is the WASDE report on Friday. It's typically not very friendly to the wheat and sometimes can be pretty unfriendly to the corn as well. It's most of the time, based upon my recollection of 2023 and looking in the rearview mirror, most USDA reports, WASDE numbers have been more favorable to soybeans. So we'll see what the USDA gives us.
We are joined today by Mike Zuzolo from Global Commodity Analytics here on Market Talk with analysis of Wednesday's trade action. Mike, one other thought I have in corn I wanted to ask you about, and I think this can go help us segue into soybeans too. Basis feels like it's gotten kind of sideways here in corn and beans in the short run. I feel like, especially in the corn market, though, basis is probably going to take over, do the heavy lifting here regionally. Would you say that's maybe the case as well?
Yeah, I think so. Other than the fund positioning, I do think the cash market is absolutely critical here. I'm hoping the Mississippi River levels go up with some of the rainfall we're seeing. I did see this week where the Cincinnati and Memphis basis levels for corn were starting to perk up, starting to see some ethanol plants maybe perk up a little bit. But yeah, I think that's a really key piece of the puzzle when it comes to the overall corn price dynamic. You know, we've talked about before, Jesse, the idea of March corn getting up to 520 to 540 to make some more hedges. I got some more soft red wheat hedges and hard red wheat hedges made today for 2023, doing some catch-up selling. I would love to get some 2023 sales made in the corn here in the next 30 days with the help of that cash market.
Let's talk soybeans, Mike, and let's look at a world soy chart as well, kind of the same as we did with corn and wheat here today. Soybeans, I know we've broken through some key support, that psychological 13 mark on the board. That's been a point I've been watching. Your thoughts with soybeans right now and U.S. competitiveness right now?
Yeah, this is a really tough market right now because, yes, we've gotten some better weather in Mato Grosso, the northern parts, the center west area of Brazil, but we're still way too wet in the south as I see it. And I think numbers, generally speaking, are coming down for both corn and bean production for 23-24 by the privates. And some are as low as 150, 151. I still am at about 156.5 on the soybeans. This chart's kind of a two-part chart because you notice the Brazil price at Paranagua, Jesse. We talked about this a few weeks ago, and the vessels being backed up, and this maybe being one of the big reasons why we've seen China come in and buy beans consistently. That 464 a ton price versus where it was back in late October, early November of over $500 a ton after spiking. I'm not so sure that's not because they're still having difficulty with their transportation logistics. Buyers having to pay demurrage because they can't get the vessels in. And so that's something to really watch here, along with the WASDE report. Is I'm really wondering whether that 464 in the Brazil Paranagua port price isn't kind of the bottom of the barrel as far as prices going forward here, and we're not making a low. And here's the vessel lineup in terms of where we're at with bulkers right now. And you can see right in the middle of the screen, the Paranagua port. And you can see a lot of ships there. And then outside Paranagua, quite a bit still, I would call backed up. Not as bad as it was a month ago, but still looking pretty heavy at this point. So I'm just kind of signaling a warning flag that maybe that 464 Paranagua price, while the trade sees that as negative because it's much lower than the U.S. price now at the Gulf, maybe that's got some infrastructure and supply chain issues wrapped up in it. So let's keep an eye on that.
Good things to consider. Good things for sure. Let's move over to livestock trade here, Mike, and I'll pull up our final chart on the video feed today. Feeders and fats. Just another rough day on Wednesday. I know we've been trying to make sense of this market as much as everyone else has been too, and I think I'm running out of things that make sense to me in this cattle market, I guess. Best way I could put it, Mike. But talk to me about this chart and your thoughts. Maybe you have better thoughts than I do in terms of this cattle market right now.
No, I'm beginning to think that cattle are made up of half rubber, half stone, because one day they bounce like a ball and the next day they sink like a rock. I continue to think that we're getting very heavy negative news out of the hog complex. And we got new news from China's big hog producers early this week. As I said at the top of the show, we got fresh news that we've got issues with the Smithfield shutting down more production here in the United States. That just ends up being more liquidation and more pressure on the beef side of the equation for the consumer side of the equation, I think, in the trade's mindset. So I think it's given the funds a green light to keep selling rallies at this point. But this chart right here is an overlay of January 24 feeders compared to January 15 feeders. And I like that correlation between 14 and 15 with what we're dealing with right now. And you notice that we have now gone back down to the lows. We've tested the lows from last week. We're also now at the lows again from where January made their major lows in the month of December, only later in the month. Notice that the January 15 feeders went off at about $214 a hundredweight, and we're sitting at 210. Midday today, we're at 215. So I will reiterate what I've told you before. I think we're very well balanced in this market. I think the fat cattle have a better rally potential than the feeders because we have, I think, worked through quite a bit of cattle. But having said that, the feeders led this market lower. I think they're going to have to bottom first, and that's what I'm watching for. Last thing I'll say is the WASDE report for the cattle could be every bit as important as for corn, wheat, and beans, because USDA last month gave us a Q1 average price for 2024 of $185. Are they going to stick with that, even though we're almost $15 below that on some of the recent cash trade?
You mentioned some of the negative news in the hog market too. I just want to ask you about that. I know the China news, I'll throw in there too. Brazil found a case of classical swine fever. I saw that in the news headlines Wednesday morning. I don't know how much impact that'll have necessarily, but hogs just feel like, to your point, that had quite a bit of negative news. Hog market here in the U.S., futures at the CME largely been kind of mixed here. It feels like the last few sessions, Mike.
I agree. And one of the things that I've been noticing is the national pork price, average carcass price is around $54. And yet that December hog futures and the cash index are upwards of 66, 67 plus. And that bothers me because I really wanted to see the seasonals kick in for the hams. They have, but they really haven't affected the cutout as much as I'd like them to. So I continue to see the cattle and the hogs and the equities as the most negative features to potentially the cattle market, and as well the currency markets and the import numbers coming in from Australia and Brazil when it comes to cattle. But I continue to feel as though hogs in and of themselves, I thought that we would have a low by the time we got to the Deese Hogs and Pigs report. I'm now wondering if we can make a low, because are we still liquidating here in this country? And are we also liquidating or getting ready to liquidate in China? And I think that's at the heart of what's going on in the livestock market right now.
Well, Mike, let's put a bow on it for today's show and wrap it up. Final thoughts, anything else you want to mention to folks or reiterate today?
I would say that we could continue this market rally in the grains if the WASDE report gives us the ability to do that, Jesse, because I do think we are a lot different in sentiment of trade versus where we were 3 weeks ago. I would also say to the energy traders out there that I would be looking maybe at a low in the crude oil, especially as we get into the end of this month, first of next month, between the dollar, I think, needing to go another leg down, and also the fact that we have now taken out some major support and back to $70 in crude. I think OPEC will continue to ration supply. Even though we're pumping up the volume, I think they'll continue to ration supply and keep this market in balance. And then throw in the Middle East. I think another 15, 30 days, we should have some long positions maybe in place in the crude oil market.
Well, Mike, if folks want to reach out and find a trial of your research and analysis, give you a call. That phone's been ringing, which is I like to hear that. That phone's been ringing. It's a busy day there at Global Commodity Analytics today. If folks want to get a hold of you, Mike, on the phone or online, how can they reach you, my friend?
Yeah, best place is to go to globalcomresearch.com. Globalcom with 2 M's, research.com. You can sign up for a free trial. I'd love to hear from you too. There's a toll-free number on that website as well.
Fantastic. Mike Zuzolo, Global Commodity Analytics. Always appreciate the time. Thanks for joining us on Market Talk, and we will talk to you again next week.
Appreciate it, Jesse. Thanks for having me.
And that's going to do it for Market Talk today. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.